When you're moving your retirement money around, that phrase tax-free rollover feels pretty solid, right? It sounds safe, it's what everyone tells you to do. But what if there's a hidden trap inside that simple phrase? A trap that could seriously drain your savings? Well, today we're putting on our detective hats and investigating the rollover state tax trap.
So let's just get right to it with a big question. The one that could save you a world of financial pain. When the IRS says your rollover is tax-free, does your state automatically agree? You'd think so, but the answer is a big, flashing no.
And hey, don't just take my word for it. Our source material puts it bluntly. Assuming the feds and the state are on the same page is a dangerously flawed assumption. This right here, this is the heart of the problem, and it's where we need to start digging. Okay, first things first, we need to understand the basic conflict. Think of it like this. It's a classic case of federal rules clashing with states' rights. And guess who's caught in the crossfire? Yep, your retirement account. Here's the deal. On the federal level, the IRS made rollover rules so you can move your retirement funds around. Give them portability, without getting slapped with a tax bill right away. But, and this is the part everyone forgets, each state is its own little kingdom when it comes to taxes. They don't have to follow the federal playbook. And a lot of them, well, they just don't. They get to decide what they consider taxable income. So, how in the world does a transaction that's tax-free to the IRS suddenly become a taxable event for your state? Let's dust for some legal fingerprints and see exactly how this trap is set. The key piece of evidence here is a legal term called non-conformity. It sounds complicated, but it's not. It just means a state has decided not to copy and paste the federal tax code. When a state doesn't conform on rollovers, it basically creates a crack in the system, a crack your money can fall right through. Now, this is where it gets really clever and sneaky. The most common way this happens is with something called the AGI Ad-Back. Here's the play-by-play. 1, you take money out of your 401k. 2, for just a second, on paper, that big number makes your federal adjusted gross income, your AGI, look huge. 3, you put the money into the new account, and the IRS says, okay, we'll ignore that income bump. But here's the kicker, step 4. The state looks at that temporarily massive AGI, uses that as its starting point, and sends you a tax bill on it. They completely ignore the fact that you rolled the money over. And just like that, the trap is sprung. And that's not the only way they can get you. The trap can also go off if you roll over after tax money that your state never had a chance to tax before. Or it can even happen just by moving to a different state in the same year you do a rollover. It's a real minefield out there. Every trap needs a tripwire, right? Something that sets the whole thing off. For this tax trap, it's a deadline. And it is brutally, unforgivingly strict. 60. Just 60. That's how many days the IRS gives you to complete a rollover. You pull money out of one retirement account and the clock starts ticking. You have exactly 60 days to get it safely into another one. There's no wiggle room here. Let's make this real. Imagine you take your money out on June 1st. You have until July 31st. That's it. If you're even one day late, the IRS says, sorry, that's a taxable distribution now. And this is the perfect excuse for the state. They can just point and say, see, even the feds agree it was a taxable event. It validates their entire claim. And if you think that's complicated, try moving. Usually, it's your residency when you took the distribution that counts. But some states are really aggressive. They might argue that if you moved in and became a resident by December 31st, they get to tax that rollover. It can turn into a huge mess really fast. So you get this surprise tax bill from the state. That's bad. But believe it or not, that's not even the worst part. The real damage is the chain reaction it starts. Our source material calls it the double torpedo effect, and it can absolutely wreck your retirement budget. So torpedo number 1 is aimed squarely at your Social Security benefits. Whether or not you pay federal taxes on your Social Security depends on something called your provisional income. And that number is calculated using, you guessed it, your adjusted gross income, or AGI. So check this out. You get that unexpected state tax bill. To pay it, you probably have to pull more money out of your retirement account. That extra withdrawal jacks up your AGI. And as you can see here, even a small increase in your AGI can shove your provisional income over a critical line. Suddenly, up to 85% of your Social Security benefits, which might have been tax-free, are now taxable by the federal government. A state problem just blew up into a federal one. And just when you thought it was over, here comes the second torpedo.
That same inflated income can also make your Medicare premiums more expensive, thanks to something called IRMAA. That's the Income-Related Monthly Adjustment Amount. Basically, it's a surcharge for higher earners.
Now, IRMAA works on what you could call a cliff system. It's based on your income from 2 years ago. Take a look at these brackets. If your income goes over a threshold by even $1 single, your monthly premium doesn't just go up a little bit, it jumps a lot. There's no gentle slope. You just fall right off the cliff into a higher payment.
And we're talking about real money here. In the example from our source, that little withdrawal to pay the state tax bill was just enough to push someone into the next IMRA bracket. The result? They're now paying over $1,100 extra for Medicare every single year, and it all started with that supposedly tax-free rollover.
Okay, so we've seen the illusion, we've examined the legal traps, and we've assessed the collateral damage. The evidence is overwhelming. This is a financial minefield. So, let's talk about the most important part. How do you get across it safely? Being proactive is really your only shield. So here's a quick checklist. First, before you even think about touching that money, talk to a tax pro who actually knows your state-specific laws. Second, do a little research on your state's conformity rules. Third, be smart about timing, especially if you're planning on moving. And finally, whenever you can, do a direct trustee-to-trustee rollover. That way the money goes straight from one institution to the other and never even hits your bank account.
In the end, it really all comes down to this one crucial takeaway from our investigation. The trap only exists because there's a gap between federal law and state law. Your job, your only job, is to know that gap is there and plan carefully so you don't fall into it.
And that really just leaves us with one final, all-important question. We all spend so much time and energy trying to understand the federal rules for retirement, and they're complicated enough. But the question you really have to ask yourself before you make your next move is this. You know the federal rules, but do you know your state's?